Let's go over understanding put options, because there's lots of controversy when it comes to buying puts and trading the markets. Are they protection? Do they work? Can a stock really crash? Well, right now in this current market, it feels like all the puts are protection against a long stock. So let's dive into it. Why would someone buy a put option that expires worthless? You may be asking yourself when you're trading. Well, think of it this way. We never know a trader's stock position. For example, if I owned 100 shares of Apple, you would never know. I could have bought it last week. I could have bought it last year. Unless you literally saw my holdings, you would never know. But if I buy a put option, let's say in 30 minutes when the market opens, that option is time stamped and approved where everyone in the whole world can see it in time and sales. So let's say I want to protect. I'm an institutional investor. I manage a big book and I want to protect some of my position in technology stocks. Let's say Microsoft. And I own 1,000 shares of Microsoft from, let's say, $100. Well, therefore, if I think the stock can decline, maybe it's an earnings event, maybe it's an investor day, and I'm nervous about Microsoft that can go lower, I can buy a put option. Usually out the money puts are more protection. A put option to offset if the stock goes down. I can possibly make money on the decline on my put options, close out my puts, or if my put options are in the money, it will offset my long stock position by selling shares at the strike price of the puts I bought. Therefore, when you're owning thousands, hundreds of thousands shares of stock, or even 100 shares of stock, remember each one option contract represents 100 shares of stock, you can see how these big institutions can spend $200, $300, $1 million on put options that might expire worthless because they own such a big stock position. Let's think of it this way. Let's say you buy your dream beach home in St. Pete Beach. You live next to Hulk Hogan. You live next to Britney Spears. And you're saying, man, I just spent $20 million on this beach home. I'm right on the water, but on high tide, and when the wind picks up, my back porch starts to flood. Well, your insurance is going to be expensive. It's going to be at a premium. Think of that as a crazy high-flying tech stock. Well, if I know a hurricane's coming next month because the weatherman had a crystal ball and forecasted it, it might destroy my back porch, even my new Ferrari that I bought that I park in the back driveway. My insurance is going to be at a premium and it's going to go up. But that's how put options work. They're going to become expensive because they're anticipation of that hurricane. That could be an earnings event for the stock. But I just spent $20 million on this beach home and $500,000 on the Ferrari, and I just redid my back porch with cedar wood floors. I want some insurance. I want some protection. Therefore, I might go take out a new insurance policy or update the one I have to cover my big home. That's how investors look at puts. Now, I hope the storm doesn't hit me, my new Ferrari, my house, my back porch is fine and the hurricane doesn't come. But if it does, you know in the back of your mind that you're going to be taken care of. That's how institutional investors, money managers think of events in the stock market, and why you'll often see around an earnings or some kind of catalyst event, the price of puts not only expand and go up in value, but you'll start seeing lots of volume in those puts because it can be scary and they don't want to lose their shirt and take a big hit on their stock position. So a few takeaways. Each put option equals 100 shares of stock. Put options that are usually out the money are usually hedges against a long stock position. Also, put prices are going to become expensive during catalyst events like an earnings and investor day, an analyst day. And 3, the stocks that are crazy, your Nvidias, your Teslas, your AMDs, your high flying movers, those puts and the price of the options in general are going to be more expensive because they have such a high average to range, a high implied volatility, and they're usually high momentum stocks. Remember, stocks can go down. You want to be protected and you want to have peace of mind when that stock does go down that you may own. That's why put options, are they fantastic trading instruments? Yes. Do you have to be correct though on timing? You're darn right. And that's why they can be difficult for the retail investor to trade. I'm Lance Ippolito. Make sure you like, subscribe, hit the thumbs up in the video, and leave a comment on maybe your biggest put option trade. Maybe it was around earnings like we did in PayPal.